We have a great show mapped out for you, and we appreciate you spending time to put your retirement planning as a priority and watching our show here. First, we're going to have you challenge you to see, is your portfolio a retirement ticking time bomb? Is there taxes out there that are going to wreak havoc at some point for you? Then we're going to have a segment that talks about frequently asked questions. All of us advisors here often, we get a lot of the same questions over and over, so we thought we'd share some of those that may be pertinent to you. Coming up then is Social Security rules. There's many different ways you can take Social Security, and some of these rules are really important. We'll see if you know some of them and maybe some interesting things you hadn't heard of before. And finally, to wrap up the show is how are you or where are you going to generate your retirement income from? All of this and so much more coming up right now on Retiring Well.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hey, welcome to this segment on Is Your Retirement Portfolio Creating a Tax Bomb? Let's start by defining what a tax bomb is. That's a situation where you end up going into a higher tax bracket where proper planning could have otherwise avoided. Let's talk about how that might, how your portfolio might create a tax bomb. Well, a lot of times it happens in those tax-deferred accounts, those 401ks. How does your tax burden increase? Well, think about your contributions to those 401ks. Think about the company match. Think about the earnings. You know, if these go over multiple years, those balances can grow to significant amounts. And so then at age 72, you know, right now as the law states, the government says, hey, you have to take a required minimum distribution. And those required minimum distributions can have some negative tax bomb effects. One of them would be the Medicare surcharges, otherwise known as IRMA, Income Related Monthly Adjustment Amount. Basically, they make you pay more in taxes through your Part B and your Part D if you make too much money. The next thing that might create a tax bomb is from a spousal plan. You know, if you're married and one spouse dies, you go from that married tax bracket to the single tax bracket. Those amounts change, and likely income doesn't drop off a lot of times. And so now your surviving spouse is going to be pushed up a tax bracket. Maybe at that point in your life, you have successful kids, your heirs are doing well, and right now there's a rule, a 10-year rule. So when you pass away, your tax-deferred accounts have 10 years to get distributed. That income goes on top of their income. And so when you think about it from that standpoint, your money might be going from maybe the 12% bracket to the 22% bracket. That's a big jump. And so if you're following your account tax dollars, that would be an example of a tax bomb. Hey, what are some strategies that we might be able to diffuse this tax bomb? I think you should research and see. Maybe we start earlier with Roth 401k contributions, or maybe you have a Roth 457 or a Roth 403b as an option. So you're participating in your employer plan, you're getting the match, but you're starting your tax diversification at an earlier stage because you put a plan in place. Maybe your healthcare plan has a health savings account attached to it, and you can contribute to that health savings account. Maybe you're on a family plan, and then you can double. You know, a married couple can double that contribution. You can start saving in an account that will go with you, tax-free on the way in, tax-free on the way out, as long as it's used for healthcare purposes. That's a great tax planning tool. Maybe you want to look at tax bracket optimization. Do you have any room left in your bracket? What do you feel about taxes? If you feel like they're going to go up later, then you're going to want to have a plan. You're going to want to know where you sit in your tax bracket compared to what the tax brackets have been in the past. And maybe the last one is life insurance. Okay, you know, we use life insurance as a tax planning tool all the time. So if you're sitting there and you're uncomfortable with what your lack of planning might be, then please feel free to give us a call. No obligation, opportunity to just help us give you a red flag review on your tax planning.
What a great segment there, Jack. Great job. You know, that's oftentimes, people don't think that long down the road, okay? And Jack talked about, okay, that tax bomb exploding when you're age 72 and you start those required minimum distributions. Oftentimes I run into clients in the Gaylord office, they'll come in, they'll sit down, we'll talk about the first few years in retirement. Let's say they retire at 62 and they've got it all mapped out until 65. But what happens after age 72 when the government says, hey, you got to start taking money from this portfolio? We have a great program where, and a great tax advisor on staff, where he can go and show, okay, over the next 10 years, if we did Roth conversions to minimize the balance in your IRA account, what would your RMDs be if we did do those Roth conversions versus if we didn't, okay? So it's just planning, getting something in place to make sure that you understand, hey, it's in your best interest to maybe accelerate those distributions from your IRA now by doing Roth conversions, so you avoid jumping into a higher tax bracket when you are RMD age. But there's lots of different scenarios where we can run into, right, Jeff?
Absolutely. You know, one of the things that people are usually concerned about is the risk in their different investment accounts. And sometimes we say, all right, do you have a Roth IRA? Oh yeah, I do. Okay, well maybe we want to take our risk in the Roth account, because then the growth can grow tax-free, and then we might take a little bit more tentative approach in the tax-deferred accounts like the 401ks, 403bs, IRAs. And by just a simple asset allocation change, their risk profile doesn't change. It just changes what their RMDs might be, you know, if markets do well. Another strategy that we use a lot was life insurance, and we say there's a lot of different products out there that can help give you that tax diversification that you're looking for. So if you're sitting there and you don't feel like you're tax diversified, you don't understand your tax plan, you're worried about a tax bomb, please give us a call. Number on your screen, no obligation, no pressure. We'll just help you learn about what's out there. Hey, coming up next is frequently asked questions and Social Security rules.
If you like watching Retiring Well, make sure to go to youtube.com/retiringwell and click the subscribe button to never miss any of our TV shows and other informative videos. Living life isn't always easy. It puts up challenges and obstacles you'll have to overcome. There are responsibilities. You put in effort to provide and take care of your family, to save and invest, to balance work and life. Planning is the first step to succeeding. Plan to retire well.
So U.S. News and World Report came out with 13 frequently asked questions of advisors. So I'd like to run through those with you, starting with the first of how do I retire? And you know, how do you transition from having a paycheck to ultimately using your retirement savings to cover your income needs? The second question, when can I retire? You know, ultimately it depends on, can you afford it? Do you essentially have enough assets to generate an income stream to cover those expenses for the remainder of your life, or if you're married, both your life and your spouse's life? Number 3, how much money do I need? Well, ultimately that depends on your lifestyle. I've come across over the past 17 years here working at Centennial Wealth Advisory where I've come across situations where people may have a significant amount of assets, but they are spending so much that they may not be able to retire. So these top 3 are essentially based on income planning. Number 4, how much will I spend in retirement? Well, that's something for you to determine, but along with that, we factor in what's the inflationary impact of those dollars over time. Number 5, should I retire early? Well, you know, you might be in a situation where you're fortunate enough you could potentially retire early. You'd want to factor in Social Security. Should you start that perhaps at age 62? Leading into number 6, when should I take Social Security? Ultimately, can you afford to delay your Social Security to full retirement age or perhaps to age 70? That ultimately might benefit a surviving spouse scenario where one spouse passes and the surviving spouse keeps the higher of the 2 benefits. Number 7, how do I apply for Social Security? Well, you've got ssa.gov is a natural way to go online, or you've got different local offices to talk to. Number 8, how much will I pay in taxes? You need to look at your combination of IRAs, Roth IRAs, what after-tax assets you have, and how you're going to draw income and ultimately then what taxes you'll pay. Number 9, pension lump sum or an annuity. This is an area where if you're in a situation like that, we definitely have to run a detailed analysis to better determine what the best way to handle that would be. Number 10, how do I afford medical expenses in retirement? So, you know, perhaps with that, do you have a health savings account? Is that something that you've already established or may want to consider establishing? Number 11, how should my money be invested for retirement? A lot of different options you can go with there, and one that you'd want to be paying close detail to. Number 12, what will I do in retirement? You know, I'd encourage you to set some goals. Maybe that's volunteering, maybe it's part-time work somewhere, something that you choose to do that you want to be doing and enjoy doing. Number 13, should I pay off my mortgage? Obviously, it's one where no debt is going to be ideal, but not necessarily everyone's in that position. So all great questions and something that perhaps caught your attention. We'd love to sit down and discuss further with you. So Art Canfield and I grew up in Traverse City here together, about a mile down the road from each other.
John and I have been best buddies since we were in kindergarten.
Met each other in kindergarten at Glen Loomis Elementary.
I still remember one of the earliest memories of John and I connecting way back in our kindergarten class.
We always would have sort of a business mindset when we were trading our basketball cards and football cards of, okay, what's the value of this versus that?
We had all these dreams of playing in the NFL together.
He was the center on the football team. I was the quarterback.
I've been protecting him my whole life, you know, and so now we get to do it in the business world.
With a little bass, here for the thrill, I don't need a chaser. Wanna vibe it to get away. Shimmy, shimmy, yeah,
each of us stood up in each other's weddings, and now we've enjoyed seeing our families grow together and spend time together.
Working with John and Art is awesome. The camaraderie that they have, the banter that you hear on a day-to-day basis is just, it's so much fun.
They're very authentic. These people are in it for the right reasons, and they're really genuinely doing what they can to help people. That, to me, makes all the difference, that I can feel good about the work that I do working with them.
Who they are as people, their values, they truly want to help people. That kind of permeates through the whole culture of our office.
Being so similar but different in certain ways is such an asset, not only for our team, but also for our clients, to be able to have, I think, our experience and in valuing relationships so importantly.
Something that's so vital within business is having that trusting relationship. As Art and I have had that trust built over the past 35 plus years now, so we have that confidence knowing that if I'm not there to make a decision, you've got a business partner that you trust implicitly to make those decisions and not question at all what direction that he's going with it or the business is going. So it's just been sort of a dream to be able to work alongside your best friend. I'd like to share with you some Social Security rules that are very important for you to be considering. So starting off, it's going to be based on, Social Security be based on how much you earn and when you begin your Social Security are going to be really important factors. But here are a few other ideas. So most workers are essentially paying 6.2% of their earnings into Social Security. If you're self-employed, that might be 12.4%. And then you can review your earnings history at ssa.gov. Which we strongly encourage because we've come across a number of cases where people have found maybe some reporting mistakes and maybe Social Security was reporting that you earned less than you actually did. So again, I'd encourage you to go to ssa.gov and look into your personal Social Security account. In 2022, there was a tax cap of $147,000. So again, there's going to be a limit on your earnings that are going to be subject to the Social Security tax, and then ultimately it's adjusted for inflation. So going back to 1990, the tax cap was at $51,300, and then in 1950 and earlier, that was $3,000. Social Security payments are based on your 35 highest years of earnings. So take that into consideration, and those are adjusted over time as well for inflation. There's a cost of living adjustment associated with your Social Security, and those are going to vary year by year. It was 0% back in 2010, 2011. Back in 1980, it was upwards of 14.3%, and then here in 2022, it's 5.9% that was increased. Your initial benefits for Social Security retirement benefits can start at age 62, but that may be 25 to 30% lower than your full retirement age, depending on your age. And maximum benefits occur at age 70, which you can typically experience a 24 to 32% amount higher than your full retirement age, again, depending on when you were born. You want to be careful if you're working and collecting Social Security payments prior to your full retirement age. There's different income limitations that adjust each year, and so you want to be careful of that. 2022, that limit is $19,560. So you may lose $1 of benefits for every $2 earned above that limit. There's no income penalties once you reach full retirement age and draw Social Security, so you could work and earn as much as you want at that point. Taxes on Social Security depends on if you're single or married, and there's an equation out there regarding half of Social Security plus your adjusted gross income that you'd want to be paying attention to. So again, as you've witnessed, there's a lot of different moving parts when it comes to your retirement plan and Social Security. If you have questions, please give us a call.
Hey, in the Cadillac office when I'm meeting with somebody, probably the #1 question that I get asked almost every time is, hey, when can I retire? You know, so many of the clients that we're speaking to here through the TV show that call in, that's their #1 goal, when can I retire? And a lot of the times I get to say, I don't know. I don't know where you are at. I don't know what you're trying to accomplish. Let's get some data points. Let's start getting some of those puzzle pieces on the table. And so we have a really cool system that we have evolved here at Centennial where we can start getting those data points. And then the more data points we have, the better our advice, the better our result of what we're saying is going to impact those clients. And then we can do that red flag review to say, listen, based on all of this data that you just gave us, it really probably is better that you keep working for this many years. Or you might find, hey, based on this data and what we see in the products that are out there, you can retire today. I'll tell you what, when they get that kind of advice and they say, I could retire today, and they understand how they could retire, there's a different sense of peace, a different sense of freedom, sometimes worrisome, because now they have to go back to work the next day. And you're always kind of curious, like, I wonder how that's going to go. But Nick, I know you are going to be able to talk about some Social Security rules, because that plays into retirement planning a lot.
That's another question that we get a lot is, how is Social Security impacting their retirement? Okay, and there's lots of different rules that go along with Social Security, but the two big ones that I come across quite frequently are, well, how much can I earn in retirement and be on Social Security without being penalized? And then also, the big question is, okay, if I take Social Security now, oftentimes they feel like they get more than what they're actually entitled to. Okay, so I'm going to answer those two different questions. So the first one there on working in retirement. Well, you can only earn so much if you're on Social Security. Okay, so that number is $19,500 and change for 2022. Hopefully that'll go up next year, but for this year, that's what it is. And the other question is, okay, when should I take Social Security? And that really falls into your certain situation. We can run numbers all day long and show you, okay, it's in your best interest to defer as long as possible. But what it really boils down to, what gives you the most peace of mind? Lots of people, I show them, hey, it's in your best interest to wait until age 67, your full retirement age. But they don't want to wait that long. They want to take it now. And that's totally fine as long as we plan for it. All right, well, stay tuned. Coming up next, we're going to be talking about how to meet your income needs in retirement.
What can Retirement Analyzer do for you? Retirement Analyzer is a software tool that can help you prepare today for your financial future. You've worked hard to save for your retirement, but as you near your retirement, you may have concerns. Have I positioned my retirement savings wisely? Have I saved enough for retirement, and will my savings last throughout my lifetime? What impact could inflation have on my future expenses? What if I suffer a long-term illness? Will I have enough money to cover my medical care expenses and still be able to meet my other financial obligations? Could changes in the income tax rates disrupt my retirement strategy? There's no need to be in the dark as you prepare for your retirement. Retirement Analyzer can help you find answers to all these questions and more. The first step is providing us with information on your financial assets, the type and current value of those assets, as well as your sources of income. Then, we work with you to identify your expected expenses in retirement. This will include a discussion of the lifestyle you envision in retirement, travel, a summer residence, whatever you dream your retirement will be. We'll input the information you provide us into the Retirement Analyzer, and in a very short time we'll have reports that show us the percentage of assets currently in high-risk vehicles as well as the percent in lower-risk products. Retirement Analyzer enables us to project your income from year to year in your retirement and see how long your retirement savings may last. As we change the conditions of the report, delaying your retirement date, including costs for long-term care, adjusting the expected tax rate, or adjusting your retirement strategies, we can see how changes in these variables may impact your income in retirement and the longevity of your retirement savings. Let the Retirement Analyzer help you test drive your retirement strategy today, because the time to discover the bumps in the road is not once your trip through retirement has begun. Contact our office today to schedule an appointment for your Retirement Analyzer review.
Let's talk about how to meet your income needs in retirement. Now, the first thing that we have to do when we do this is, what needs do you have? It's oftentimes maybe 9 out of 10 folks that come in for the first time and want to talk about retirement planning with us don't know what they need in retirement. Simply a lot of times, what is the budget, if you will? I seem to find that most people don't per se live life on a budget, and that's great. Maybe you have enough income and you're fortunate enough to be having savings and all that sort of stuff, so you haven't per se had to live on a budget. Probably internally you kind of have one, but you're not saying, you're not writing it out, or you're not divvying it up per se every month or paycheck or whatever it may be. But we need to kind of consider this when we're heading into retirement. What do you think you're going to need to live on to pay the bills and keep the lights on and do the things you want to do in retirement? So once we have that number in place, that budgetary number for expenses, how are we going to get there? Are we going to have enough to get to where we want to be? First, what do we know is going to come in? Think like pensions, Social Securities. Maybe you're fortunate enough to have like royalties off an old oil situation, rents, some maybe annuities can be kind of a guaranteed source, stuff like that. So what do we know is going to come in? And then what is our shortfall? What is the difference between what we know and what do we need? And then that's where we have to look at our portfolio, our retirement savings, whether that's a 401k, IRAs, or any of those different savings vehicles. Is now, what is that amount we have there, and what can that that produces income. Now then, so we have to consider withdrawal rates and, do you want to leave money behind, and are there other bigger purchases coming along that we have to plan for? So at the end of the day, how are we going to meet the income needs in retirement? Step one, know what the income you need is. 2, what do you know is going to come in? And finally, 3, what can that portfolio produce comfortably depending upon your situation that you want to have? Oftentimes, we see people jumping the gun a little bit on this step in their life where they come in, hey, I retired last week, what do I do? Have these conversations in advance. Have something, this is where you set goals and want to work towards so that you can feel confident heading into retirement that you have a plan and that you're not going to have a situation where you outlive your money. People's number one fear when they were polled a few years ago was actually running out of money and not dying. So make sure you have a situation to do that. You may think you have enough, but when you start drawing for that and you have to plan, maybe 20, 30 years or more that your retirement may exist, saving your savings last that long and do the things you want to do. Also, final thing I'll say on this is oftentimes people underestimate their spending in retirement. You now have all this time and you have all these dreams, and maybe it's travel or grandkids. Make sure you add those things into your budget so you can plan to retire well.
What another great segment there, and a very valid question that we come across quite frequently, especially here in the Gaylord office, where the clients want to know, okay, how am I getting this income that I don't have guaranteed from Social Security or a pension? Where does that come from? Oftentimes the majority of it does come from obviously your portfolio that you save for, but there's other ways to generate that income as well. I have a lot of different clients who don't really want to just sit around doing nothing in retirement. They like to have that part-time job where they still feel like they're contributing to society and doing something that they've always wanted to do or they've always thought they would enjoy doing. Out of the Gaylord area, a very common part-time job is working out on the golf course. Maybe they need an extra $500 to $1,000 a month, so they just cut the grass a couple times a week and they get both that extra income stream coming in on a monthly basis, but also the perk of being able to have free golf as well. So it's just important to make sure that you understand, okay, what are your income needs? And then what are the different options that you can do to meet those needs?
Yeah, I love the part-time job situation for our retirees. I think some of the happiest retirees that we have do have that part-time job. And maybe they're sole proprietors. Maybe they're working in their own wood shop, creating things. They're creating crafts. They're doing things that maybe they've done a long time. In the McBain area, huge agricultural area, a lot of farmers. I have clients that they're going to be just sitting in their tractor, mowing down that field or planting that field or just doing that farm work that maybe isn't as rigorous as it used to be because their roles have shifted a little bit. But when you ask them about it and you talk through, their income planning and what it offers them, it's peace and it's purpose and it's a little bit extra dough there. So, hey, if you're at all curious about what a good income plan looks like, how to map out income sources, not be so singular focused on Social Security, please feel free to give us a call. Thank you so much for watching our show. We love that we can try to add value to your life and plan to retire well. Tune in next week, same time, same station. Have a great week.